Okay, good afternoon, Mr. Wee, Professor Tan Cheng-Yi, NUS President, Professor Andrew Rose, Dean of NUS Business School, Professor Noah Lim, and distinguished guests. I'm very honored to be here today. By coincidence, last year's keynote speaker, David Samaya, and I are good friends from Pacific Pension and Investment Institute. PPI membership is sovereign wealth fund and pension fund managers and asset managers with a collective AUM of $25 trillion. The changing world order is at the top of the agenda of discussions I'm having with my friends at PPI like David and also at Asian Corporate Governance Association, where I serve on the governing council. ACJ's investor members manage $40 trillion. I will be sharing my insights from these various discussions. Let me set the scene for this afternoon. Sorry, I'm speaking very fast for the prompter. I have 18 minutes. We're at the precipice of a new economic reordering due to geopolitics driven by national security and the agency of powerful world leaders, Xi, Putin, and now Trump, plus Elon Musk. It is a reset of the last 80 years in 80 days since January 20th. Liberation Day tariffs. Gotta look at my latest notes. Came out at 12 noon yesterday. At 1:30 a.m. this morning, we had a tweet for a pause for 90 days for countries willing to negotiate. Perhaps he was spooked by the bond markets. Scott Bessent came out and said there's over 70 countries in line to negotiate, and that Trump is an example of Trump creates negotiation leverage for himself. But China still maintains he's put 125% in China, it remains. China's put 124% on the US. Big face issues on both sides. Where will the off-ramp be? We hear news about China, about maybe weakening the RMB, buying less US treasuries. And maybe, I think right before the meeting this morning, they were saying Chinese officials are meeting about doing more stimulus. So basically, everything is on or nothing is off the table, including decades-old alliances. What is the grand strategy? Is Trump detoxing or poisoning the US economy? Or is he addressing China's industrial capacity driven by state capitalism? It is to ensure American supremacy, scrap neoliberalism, a bold, Trump might say beautiful, others might say blow up, reordering of the global trading, economic, and financial systems. It is back to the future, mercantilism, might makes right, nation states, spheres of influence. Soft power was too nice, now it's hard power, bully and bluster. The US is no longer a benevolent beacon and bulwark. I will hazard some predictions for this new post-Cold War era as fodder for our discussion. My key themes today will comprise three areas. Of course, I have to talk about Trump. I did not vote for him. His core beliefs, he has the mandate, he's addressing grievances, the hollowing out of the US industrial base, countries free riding off America's security umbrella, and market as a last resort. There were unfair trading practices. Complicit were businesses and investors, naivete that democracy would follow trade, and American consumers buying at Walmart. He believes in zero sum. His personality can win negotiations. His 1987 book, The Art of the Deal, intimidate and double down. Several companies are promising to invest more in America. Apple, NVIDIA, TSMC. Countries are promising to buy more LNG from the States. Decision-making. King Donald and his court of oligarchs. That's the tech bros and the oligarchs. Who will push back as he holds court? The courts, hopefully. The stock market, but I was told that Trump voters actually own fewer stocks. Consumers, when they see higher prices, or maybe if he wants the Nobel Peace Prize. America's first foreign policy. It's a shift from missionary of promoting values to mobster style, pay me protection money. Does realism morph into isolationism? He is not an ideologue. He does not want war. FDR tried to engage Stalin at Yalta. Now Trump appears to be seeking rapprochement with Putin. Or is it shock treatment for Europe? Tariffs, a trifecta, a magic wand to bring back manufacturing, pay for tax cuts, and a negotiation club. Targeted tariffs would be understandable. Less so are tariffs on ships, steel, and aluminum, where there are actually few US manufacturers. Tariffs actually should be part of an overall industrial policy, not a blunt weapon that undermines WTO. And my father-in-law actually helped Singapore get into WTO, so a little bit of self-interest there. MAGA, It's protectionism, nationalism, populism, anti-immigration, distrust of elites, institutions, and media. Underlying are societal trends of inequality and a backlash towards a globalized system that has primarily benefited investors and corporations. Shareholder capitalism and financialization of the economy contributed here. The 1987 Wall Street movie, Greed is Good, made us all less caring. Globalization, multilateralism of the last 80 years was a rising tide that lifted many boats. It was an unusual period of very calm waters, underwritten by the United States through its financial and intellectual generosity to share power at a time when it was a clear number one after World War II. Middle-sized countries, what do you do if it becomes law of the jungle? The Jungle Grows Back is a 2018 book by the American historian Robert Kagan. The norm was great power rivalries and conflicts often centered on the Euro-Asia landmass. Europe, will it be galvanized to come together? Kickstarted by Germany's €1 trillion for arms and infrastructure, while noting that Europe is really a post-World War II construct and more of an economic and not a political union. Will Europe get closer to China? Well, there are differences in systems and culture. And what if there's a flood of goods redirected from China's $430 billion of exports to the United States? In Europe, FDI in USA is a few $1 trillion. In China, it's a couple $100 billion. We will see a bigger role of the state. Industrial policy, underpinned by national security, overrides the international rules-based order. Trump wants to rebuild America's industrial base. China can teach him. They became factory to the world in 30 years. Maybe the US can teach China about consumption. Politicians, pandering to populism, will dictate trade. Trade is no longer a derivative of economics. What can we do? It's Back to the Future, the 1980s movie. How did our parents and grandparents cope? Trump admires President William McKinley of the late 19th century. Nixon wanted to be an imperial president. Is Trump now doing a reverse Nixon to try to get Russia on side against China? Choppy waters gives rise to volatility and therefore opportunities. When the tide goes out, those who have swimming trunks on will attract customers and capital. Interdependence used to be a good thing. Now it is to avoid overdependence. Supply chains do take time to untangle. Let's move on to my second theme. Where are we today for some key drivers in macroeconomics? Many of the tailwinds of the last 30 years have now become headwinds. The re-emergence of China, the largest GDP in 1830, then the century of humiliation. In 1990s, it was a source to source cheap product. Then it became a big market, but then they got too big. $1 trillion trade surplus, a meteoric 33 times rise in GDP from $564 billion in 1994 to $18.4 trillion today. China makes 35% of the world's goods, up from only 6% in 2000, but they only consume 12%, and therefore have locked in many supply chains. And they are a threat to jobs and industries around the world. China shock. The China market also became the China price. Look at some of their domestic companies. BYD's 6-minute charger and over $100 billion in sales has overtaken Tesla. Of course, we have DeepSeek, and even in coffee, Luckin over Starbucks. Technology, the movie You've Got Mail. Internet dramatically lowered communication costs, but now it's about cyber risk, dual use, chips and AI are major battlefronts. The peace dividend. Francis Fukuyama's book, End of History, after the fall of the USSR. Now we have the Middle East and Ukraine conflicts and potentially Taiwan. We had the US-led unipolar world. The American economic historian Charles Kindleberger said, "You need a dominant power for stable, harmonious economic relations." It may fast be becoming a hybrid of a multinodal world with swing states amongst 19th century type great power maneuvering. 7 of those states remain: UK, Germany, France, Italy, Japan, and US. Add to that China, Korea, Canada, Brazil, the global south, including former colonies, India, Indonesia, much of ASEAN. Many more pieces on the board. Better learn how to play Go, not chess. Low inflation and low interest rates. China and globalization has been deflationary. Now there's tariffs. I believe inflation will structurally be higher in the West for what I call the 11 REs. Rewire toward a clean economy, restock, reshore, reindustrialize, rearm, retire due to demographics, repay government debt, repair climate change damage, regionalization, resilience, and redundancy. Interest rates, a dilemma for the Fed. Do you cut them if there's a recession, or do you raise them to counter inflation and if foreigners buy less U.S. treasuries, like maybe China might? Demographics, they were a big driver for the last 30 years, such as in China, but not there anymore as in elsewhere. Climate change is even more urgent, and government debt. U.S. government interest payments now are $880 billion. China's total debt, including local government and their financing vehicles, is 312% of GDP, but fortunately all domestically held. This at a time when military expenditures and the cost of climate change are increasing. The U.S. dollar, exorbitant privilege, reserve currency since Bretton Woods. Will this diminish due to the U.S. government's fiscal situation, weaponizing the dollar, erstwhile allies or others less willing to hold dollars, and if the U.S.'s share of world trade declines? But what is the alternative? And Trump does want a weaker dollar to boost U.S. exports and reindustrialization. Growth, a slowdown caused by tariffs and uncertainty. China is transitioning to advanced high tech. They're installing half of the world's industrial robots. Europe is stagnant. In the U.S., there's talk of a recession. But is it still the best house in a lousy neighborhood? Industrial policy and national security of supply chains, energy, technology, and food. They create a much more fragmented and disrupted world. If you do not have an industrial policy, you are following China's industrial policy. U.S.-China. I'm Chinese-American, very sensitive issue here. Each has a big spillover effect to the rest of the world. China's manufacturing capacity, the USA's policies on trade and the US dollar. Let's look at the tail of the tape. China, it has the advantages of supply chains, its manufacturing cloud, a big domestic market, and a large pool of STEM graduates. It has the downsides of what I call the 7 Ds. Demagogue, debt, decline of tax revenues, deflation or Japanification, demographics, depend on exports because their other 3 sources of demand are insufficient. Real estate still in a slump, infrastructure, how much more high-speed railway do you need? And then there's consumption, which remains at a low 38% of GDP. Let's look at the US now. It has the big consumer market, $19 trillion of $115 trillion, double that of the EU and 3 times that of China. It has the reserve currency, and it had alliances. It has the advantages of the 5 I's. Innovation, insulated by 2 oceans, independence for food and energy, until recently, immigration and institutions. Both my parents immigrated from Shanghai to the US in the 40s, made a life for themselves. My dad became a tenured professor at UC Davis. My mom became a United States ambassador under Clinton to the ADB. But the US now faces the 3 I's: insecurity, inequality, and huge internal issues. I'm being very neutral here because I have friends on both sides. Xi and Trump actually have many similarities. They both want to fundamentally remake their economies. China away from real estate fueled by debt, and the US to bring back manufacturing. They both believe their system is best, 2008 being a watershed moment for China's view on Western capitalism. Well, Larry Fink said it worked, but just for too few people. That was in a shareholder letter last week. They both desire to make their countries great again, but what's the benchmark? Trump admires the Gilded Age. For China, is it before the century of humiliation? They both demand absolute loyalty. They admire other strong leaders. They want to maybe extend their terms. They both face debt issues, 124% of GDP. That's the US government. It's also the Chinese government debt if you include local government and local government financing vehicles. Same number, pure coincidence. AI perplexity. They both face inequality, 0.47 Gini coefficient. Again, pure coincidence, same number. They both need to create jobs. China's lie flat, Tanping, and J.D. Vance's book, Hillbilly Elegy, about the hopelessness of the Rust Belt. But will AI take jobs too? They both face a reduction in GDP growth due to these tariff wars. In the near term, it may be who loses first rather than who wins. Trump may be thinking that China is economically vulnerable now, so the US has economic leverage. Therefore, short-term pain is worth it in the long term if tariffs hurt China more, and also worth it toward a longer-term goal to remake the US real economy, Main Street, not Wall Street. This will test the US society's pain tolerance, while China's system can better manage theirs. Finally, let's discuss my third theme, what to do going forward. Do not let geopolitics distract us from climate change, which is existential. Nature will force this issue. Complacency, we need the resilience of our parents and our grandparents. We need to talk to people at gatherings like this one, because there's too much news out there, fake and biased. We need to review our business strategies with a geopolitical lens. Global businesses are disproportionately affected by the specter of tariffs, sanctions, and foreign investment restrictions. We need to review our operating footprint. Where do we put our supply chains, money, boots, technology, and data on the ground or in the cloud? More scenario planning needs to be done around various uncertainties. Tariffs, where do they land? Got to look at by country. What is structural, such as climate change and demographics? What is cyclical, such as populism and protectionism? And what is idiosyncratic? Will Donald Trump go for a deal with China? Well, he's talking to Iran this weekend. Will Europe, albeit reluctantly, continue to support the United States when called on, or will they become more Gaullist? Will we go back to, and I learned this word only about a year ago, autarky, A-U-T-A-R-K-Y. Then we have blocks of US, China, and Europe. In that scenario, wither the smaller countries. Does Trump drive the smaller countries to China or coerce them to stay as the lesser of two evils? Can the US wean itself off of China's supply chains? In what sectors does the US have sufficient qualified labor at the right cost? We're in the shipping industry. China only made 5% of the world's ships in 2002. They now make 55% of the world's ships. Can there be a trading bloc without the United States? Well, actually, the US is pretty close, accounting for about 11% of world trade. I think ASEAN ministers are meeting today to discuss this. Governance. More attention needs to be paid to increased costs, disrupted supply chains, geopolitics, and AI. Technology does have the highest chance of bifurcation. Strategies. It really depends, are you an investor or you're corporate? And if you're an investor, are you an institutional investor like the PPI and ACJA people I know, or you're a family office? Or are you a multinational or a regional corporate? And of course, there's the macro situation of less trade, slower growth, and increased inflation. For institutional investors, my friends at PPI and ACJA, well, gold's at an all-time high. Some can no longer invest in China. US exceptionalism. Is it the safe haven? And deregulation and tax cuts will give it a boost. For diversification, for these big guys in the US and Europe, in Asia, for public markets, other than China, only India and Japan markets have sufficient liquidity, actually. Now let's talk about the corporate side. Multinationals. Are MNCs too large in a more complex and shifting geopolitical landscape? The China market, they need to consider the headline risk as well as formidable local competitors. In some markets, it may be better, and I'm self-interest here, better to outsource by partnering with regional businesses. Regional, often family businesses, are nimbler, more in touch with home market politics, and think longer term. I've also been given a few minutes to talk about ASEAN, which everyone in this room knows better than me. 9 of 10 ASEAN countries became independent countries post-World War II. They have only known and benefited from the US-led rules-based order for their export-driven development models. They were going to face the China price or China shock regardless. They need to focus on their domestic economy and middle class. ASEAN needs to continue being the balancing act between being the grass with two elephants. It's not getting easier. Ask Li Ka-shing. They face the twin issues of being collateral damage in a trade war and a spillover of industrial capacity from China, again, the China price. They benefit from being the child of two divorced parents showering gifts on them, and they can play the role to the middle person to cool things down and a key part of supply chains. Okay, let's look at some strategies and opportunities in ASEAN. I had in my speech about China +1. Of course, the Liberation Day tariffs seem very targeted at this back door with very high tariffs. on Vietnam at 46%, Thailand 36%, Indonesia 32%. There's a pause. I guess it's up for each country to go cut a deal. India and Japan are keen for closer ties with ASEAN. Hopefully there's more impetus to use RCEP, CTIP, and TPP trade agreements to catalyze Asia for Asia trade. Energy and climate transition are critical in ASEAN. Maybe we can leverage China's clean energy supply chain, a new form of BRI. They can fill the gap of Western investors pulling out of China. They can play the correspondent bank-type role to multinationals who decide no longer to have operations here. Okay, here's the conclusion. Benefiting from the discussions with friends around the world and across the political spectrum in various forms, I conclude that investors and companies need to focus on bargains. B is for back to the future. Study how businesses and investors survived 1970s stagflation, 1930s populism, protectionism, and strong leaders, and the late 19th century great powers era. A is avoid TDS, Trump derangement syndrome. Cut through the noise. R stands for right-size your companies to navigate the cross-currents in a geoeconomic fragmented world. Gains. Use decision-making lens of G for geopolitics, A for AI, I for industrial policy of the countries that you operate or invest in, N for natural capital, climate change, and S for security of your supply chains and technology. I would like to thank Geraldine Chin for the faith to recommend me to be today's keynote, and Dr. Love and his team for convening today's very important gathering. I look forward to this afternoon's two panels. Thank you very much.